Hi, everyone.
How's it going?
How you doing?
I'm all right. How are you all?
Not too bad.
Anybody get arrested over the weekend? Okay. So, this sucks. We started chapter 5 last time, right?
Yeah, I think we ended on slide 13.
Thank you. We talked about wealth, return, risk, and liquidity, the theory of portfolio choice, supply and demand in the bond market. We'll talk much more about this. So we said the supply and demand in the bond market. Market equilibrium occurs when the amount people are willing to buy equals the amount people are willing to sell. It's fairly self-explanatory, right? Changes in equilibrium interest rates. Then we started to talk about shifts in supply and demand. So shifts in the demand curve for the bond market depends on wealth. In an expansion with growing wealth, demand curve shifts to the right. Yeah, that makes sense. If we all have more money, a prosperous economy, more people will have more money. The demand for bonds will increase at every price. That means the curve shifts to the right. Similarly, if the economy were bad, the curve would shift to the left. Expected returns, a higher interest rate would lower prices, lower the expected return on the bonds, thereby shifting the demand curve to the left. Lower interest rates would increase the expected return, thereby shifting the demand curve to the right. Inflation, higher prices on houses and cars would lead to higher nominal capital gains, which would increase the return on those assets, houses and cars. The relative rate of return on bonds would be lower, thereby decreasing demand and shifting the curve to the left. An increase in the riskiness of bonds causes the curve to shift to the left. Increase in riskiness of bonds causes demand to drop. Increased liquidity increases the demand for bonds, shifting the curve to the right. I want to talk more about this. Expected inflation, an increase in the expected rate of inflation lowers the expected return for bonds, causing the demand curve to shift to the left. We're talking now about a relative return because higher prices on houses would lead to higher nominal capital gains, which would increase the rate of return on your house. So if we have a lot of inflation, you're going to see your house price appreciate significantly. The relative rate of return on a bond would be less, thereby shifting the demand curve to the left. Does that make sense to everybody? Anybody have questions about that? This is what we see when we see the shift, right? This is a shift in the demand curve, increase in the bond demand. I think we left off here, as someone mentioned. And this just shows a shift in the demand curve for all of these events. Yeah, wealth, interest rates, inflation. Change in inflation goes up. The shift in the demand curve is down. All right, everybody cool? The supply curve. Expected profitability of investment opportunities. The supply curve would shift to the right. In an economic expansion, firms are more willing to borrow, right? i.e., issue bonds. So the supply curve in the bond market shifts to the right. Expected inflation. An increase in expected inflation shifts the supply curve to the right. If expected inflation increases, the real cost of borrowing decreases. The difference between nominal and real interest rates. If the real cost to borrow is lower, the supply of bonds will increase. Government budget, increased deficit shifts the supply curve to the right. Governments are usually running a deficit, so they're usually borrowing more and more money, so they shift the supply curve to the right. The two things here that I'm most interested in is inflation. So we said that do you guys understand why an increase in expected inflation shifts the supply curve in the bond market to the right? Go ahead, Jake.
Like sort of. It's not like completely clear to me.
So what happens is the real cost of borrowing is lower when we have inflation. Let me use an example, right? You guys borrow 10 grand each year to go to college. Yeah? And so when you graduate from Bonos, you got $40,000 in student loan debt. Well, if we have very serious inflation, your student loan debt is still going to be $40,000. But at the moment, you graduate from Bonnas and you get a job making 60 grand a year. And you got to make a monthly payment on that 40 grand. If we have very serious inflation, your salary will go to 150 grand a year. But your student loan debt will still be 40 grand. So the real cost associated with your student loan debt is much lower because we've had significant inflation. Does that help?
Yeah.
So in periods of expected high inflation, the real cost of borrowing money is lower. The real cost. Similarly, when we looked at the demand curve, when we have expected high inflation, you buy a house and the price of the house doubles. Yeah? You're not interested in getting that 3% on the freaking bonds. You know what I'm saying? So you just buy houses, you don't buy bonds, because inflation is driving up the price of the houses far more than you would make if you invested in the bond market. Here we see this self-explanatory picture again, profitability of investments. They're going to borrow more. Inflation, they're going to borrow more because the real cost is lower. And the government, they always run a deficit. And then we see this is what a shift in the supply curve looks like. Change in expected inflation. A rise in expected inflation, better returns on houses and cars, so relatively lower returns on bonds, so shifts the demand curve shifts to the left. Right here. Step one. Step two, rise in expected inflation makes the real cost of borrowing lower, shifting the supply curve to the right. Causes the price of bonds to fall and interest rates to go up. Cut out all the middle steps and we have inflation and interest rates go up. Okay? It's all cool, right? An observation. When expected inflation rises, interest rates rise, the Fisher effect, right? So here we see figure 5 in the textbook. Let me see what the caption is on figure 5. Figure 5. Interest rate on 3-month T-bills and expected inflation generally move together as the Fisher effect would predict. Response to a business cycle expansion. A business cycle expansion will shift the bond supply curve to the right. Step 2 shifts the bond demand curve to the right, but by a smaller amount, perhaps. Step 3, the price of bonds will fall and interest rate rises. So in an economic expansion, businesses are more likely to borrow. That shifts the supply curve to the right. Expansion in the economy makes people wealthier, so the demand curve shifts to the right. This price change here could be ambiguous, but typically the supply curve shifts more than the demand curve, resulting in an increase in interest rates and a decrease in the price. The data tells us interest rate rises during periods of expansion. So these gray bars are periods of contraction. All right, 22, supply and demand, the liquidity preference framework. Rather than get right into the liquidity preference framework, because you're just listening to me prattle on, I think we'll do some of the problems associated with the material we just talked about. Come back and do the slides for the rest of the chapter and then the problems with that, right? This way we have a variety of experience in your money and banking class in each class. Isn't that exciting? So let's do 1, 2, we've got 1, 2, 7, 10, and 11 that pertain to the material we've just done. So I'm going to put you in the, how many are you? 30. I'll put you into 5 groups and we'll come back in like 10 minutes and discuss them.
Yo, where'd they go? Oh,
Is it fun to go into breakout rooms?
Yeah.
yeah, I was a little sad that I had to leave.
What?
I was a little sad that I had to go.
Oh, yeah? Um, hey, everybody send me a chat hello so I have attendance. Okay, who wants to tackle number one?
I got it. For 1A, you said that you'd be less likely to buy a Microsoft because you have less money to spend on it.
Yeah, you don't have so much wealth. Yeah, good.
And for B, we said you'd be more likely just because you'd expect Microsoft to appreciate in value too.
So that's a what? Relative change.
Yeah.
This notion of relative is very important, folks.
And for C, we said less likely because you'd probably just want to buy bonds instead, maybe.
And that's also a relative change. Very good.
And then D, less likely because buying gold would probably just be better.
Yeah.
And then for
Yeah.
E, we said more likely because the bond market is more volatile and more risk.
Yeah, so it's less risky relative, right? Anybody have anything else? So you don't have to be a rocket scientist to know that if you had something else, you wouldn't say anything, right? So what was next? Number 4? No. Number 2.
Yeah, so we had number 2. So for A, you just inherited $100,000. We said you'd be more willing to buy a house because you have more money to buy stuff with.
Yeah.
And for B, real estate commissions fall from 6% to 5%. So we'd say you'd be more willing under that circumstance too. C, we expect Microsoft stock to double in the next year. So we said you'd be less willing to buy a house since you'd be better off putting the money in Microsoft.
Yeah.
For D, prices in the stock market become more volatile. We were a little unsure about this one, but I think it is you'd be less willing to buy a house. I don't really know why. Less willing to buy a house because since the stock market's so volatile, it's hard to predict where the market's going and how much that house, I don't know, will be worth or something like that. And for E, you expect housing prices to fall. We said you'd be less willing to buy it since you could probably get it for a cheaper price in the future.
Okay. Thank you very much, Matt.
Yep.
So we need to talk about 2 of these, okay? You can, prices in the stock market become more volatile. You were unsure about that. So if the stock market is more volatile, in other words, it becomes more risky, well, what does that make you think? My neighbor has a dog. You guys ever hear the TV show, The Little Rascals?
Yeah.
Remember their
Yeah.
dog, Petey? They had a dog that had a the fur around one eye was black. Yeah, I'll Google Petey from the Little Rascals. Anyway, I got a neighbor that has the freaking same exact dog, man. And it's named Petey. They were just outside. So the stock market is more volatile. What's that going to do, man?
You'd probably be more likely to put the money into housing at this time.
Thank you. Yes, you're going to be more likely. You and your wife, you and your husband are sitting around saying, Jesus Christ, look at the stock market goes up and down and up and down. Should we buy that house or should we put our money in the stock market? If you said, oh, let's put our money in the stock market, your spouse would be like, oh my God, what happened here? Yeah. So the next thing I want to talk about is part B, number 2. What is the phenomenon that we're talking about when real estate brokerages go from 6 to 5%? What is that? What kind of an effect is that? That's a liquidity effect. Yeah? If you were trading in the stock market and commissions went, from, well, a real life example is it used to be years ago that brokerage fees were fixed on the New York Stock Exchange. And one of the movements that they put through, and I can't remember when it was, it might have been like in the late 80s, they said they freed up, the brokerage houses were free to charge whatever they wanted. So when they lowered brokerage rates, it increased the competition and it made the market much more liquid. So this is a liquidity effect, okay? But very good. Thank you, everyone. How about number, what was it, 7?
Yeah. So the question was, can you tell if Maria is more or less risk averse than Jennifer? So Maria prefers to buy a bond with 7% expected return and 2% standard deviation, while Jennifer prefers to buy a bond with 4% expected return and 1% standard deviation. So we said that she's less risk averse because she's okay with taking on more risk for the bond with a higher return and greater volatility.
All right. Anybody have another, thank you, Paige. Does anybody have another take on this?
So I was kind of thinking that it's kind of hard to like compare the two because they're investing in bonds with different expected returns. So I didn't know if there was enough information to compare the two.
Very good. Thank you, Jake. Anybody else have some thoughts about this one?
Isn't the standard deviation like a measure of the risk? So like a lower standard deviation would be less risk than, so like, what's her name? Jennifer would have less risk because her standard deviation's lower.
Yeah, that's right. Well, Ryan, go ahead and tell us what that all means as standard deviation.
I don't really know what like the standard deviation is, but I know that like it's a measure of risk. So I just thought since it's lower, it means less risk.
Yeah, that's exactly right. Anybody want to help a little with this definition? The standard deviation of returns is a measure of the variability of returns around a mean. So for a standard deviation of 2%, that means that on any given day, the returns could be up to 2% or down, or a loss of 2%, around zero, right? If the mean return was 5, they could be up to 7 or down to 3. It's a measure of variability of returns around the mean. So that's exactly right, Ryan. But in fact, I think Jake nailed it here because we really don't know. So Ryan, you're exactly right. The standard deviation is a lot less. It's 1% versus 2%, but the return is also a lot less. So there's a trade-off here, right? What's her face who has the 1% risk? She's not making very much money, And the other dude, whatever her name was, she's got 2% in risk in standard deviation, but she's making considerably more money, I think 7%, right? So in actual fact, we can't answer the question. We would have to compare two stocks that had the same return and look at their standard deviation. So very good. Thank you, everybody. How about what's next? Any questions on that one? Ten, what's going to happen?
Would the interest rates decrease because the price of the bond is increasing with less bonds in the market?
Yeah, how did you determine there were less bonds in the market?
Because it says if it's too costly and many big corporations decide not to issue them, then there's going to be a smaller amount.
Right. So we would have a shift in the supply curve, right?
Yeah.
So it would go like this, right? So the supply curve would shift to the left. And the price of the bonds would go up. So the interest rates would go down. Okay. How about number 11?
For number 11, we said that the crisis would lead to a lower wealth and income, which depressed the treasury bond demand. And also, they'll decrease the corporate bond supply by even more because investment opportunities would collapse.
Yeah, but then what would happen?
With the treasury or
Yeah, treasuries become a safe haven, doesn't it say that?
yes.
Yeah, it says that. So treasuries become a safe haven, right? Throughout the world. That increases the treasury bond demand. That increased treasury bond prices, which lowered the yield. Yeah, makes sense?
Makes sense.
Okay, any questions? All right, let's have a look at where we got to go. So, what day is it? Monday. Hey, we got to have an exam after chapter 6. So we should finish chapter 5 probably Wednesday, start 6. So it would be either the end of next week or early the following week that we have an exam. I've got to figure out how to do it. Probably I'll do it on Moodle. But I don't want you to collaborate. All right, so let's, let me just show you where we're going and then we'll call it a day, okay? God, it's hard. So we want to talk about the liquidity preference framework, yeah? And we're going to talk about this, the demand for money and the supply of money, how they affect the interest rates through the liquidity preference framework, and does it work? Money and interest rates. We have a price level effect, expected inflation, and what does it do? So over time in money supply, what do the changes in money supply do to the interest rates? And then we'll call it, and then there's a bunch more problems from this chapter, some to discuss and some applied that we will do when we finish the slides next time. Okay? Any questions? Everybody cool? All right, we'll see you on Wednesday. Thank you, everybody.
Thank you.
Thank you.
Thank you.
Thank you.